Hello, good day. Our topic for today is all about effective financial planning. But before we proceed on the subject matter, this video is actually the second part of the video. The first part is on my website. I highly recommend you watch first the first part, or after watching this, you watch the first part. The first part is you visit our website, www.taxcall.ca, and in there, you click on tax tips. And once you are on our website, look for types of life insurance comparison. Okay, once you watch that, the next part of the video makes a lot of sense. With so many advice from different financial advisors, from the bank's recommendations, from different investment dealers, sometimes it becomes too confusing to the client as to what particular plan is really better for me. Okay, a lot of financial advisors would recommend you to get a life insurance, and I agree with them, especially if you have young children and a family depending on you. At the same time, they will also recommend you to get an effective retirement plan. Why? Because we don't want to become a burden to our family by the time we reach our retirement years. So, life insurance and retirement plan are essential for an effective financial planning, but sometimes it becomes too expensive, right? But I have a perfect solution for that. Okay, we call it universal life policy with retirement options. So what it is actually a life insurance which can transform later on in life into a retirement pension. So the death benefit of this is also tax exempt. But the main difference between this type of insurance plan compared to other life insurance plan, this particular life insurance plan has the possibility of giving the client a lifetime pension cash flow. And the pension cash flow on this particular plan may also qualify as a tax exempt under our very effective tax planning strategy. And the life insurance component of the plan will always be there, so the client will be enjoying his retirement cash flow for so many years, and after the client's death, there will still be a sufficient amount of financial benefit to the family members. Okay, so let's take this 30-year-old female client. Most likely, a lot of people would tend to buy RSP or TFSA for their retirement. So we say $150, and then another life insurance of $150. And if this client is a homeowner, she would get another $70 for a mortgage insurance. And now critical illness has become more popular, so another $50 to $65 in critical illness alone. So this client actually paid more than $400 monthly. Okay, don't get me wrong, this plan is really good, but it becomes too expensive. I may have a perfect solution for that. Universal life with retirement options, $200 per month, so that's the client's retirement plan, no need to buy RSP or TFSA. Then it already has a built-in life insurance plan, so no need to buy another life insurance. Since it may be able to have a bigger coverage, so no need to buy another mortgage insurance. Plus, we can also include critical illness on it, so for a total cost of $200 monthly. So if you compare both plans, which one do you think is better? In fact, the total savings is more than $200, and the client can utilize that savings for her emergency plan or vacation plan. Okay, let's dig deeper more into this particular plan. So that $200 monthly, the contribution period is only 20 years. After 20 years, it may generate enough growth in order to pay for the life insurance until the client dies. So the life insurance coverage for this is $700,000 with critical illness of $30,000. And the projected cash value of this plan at age 67, once the client turns 67 years old on her retirement years, it will be around $388,785. Again, this is not guaranteed. This is based on an 8% average rate of return. But if we look at the market way back 20 to 30 years ago, the investment market, especially the US market, is making way more than 8%. In fact, the average in the market is between 12 to 14%. If what had happened in the past 30 years will happen in the next 30 years, actually this client will get way more than $388,000. But again, this is not guaranteed. If the market will perform way less than 8% in the next 30 years, well, the client will get a little bit lower than $388,000. But again, this is also a life insurance plan. Okay, if there's not enough cash value for retirement, at least the client is insured for $700,000. Okay, let's talk more about the cash value. Again, the cash value is not guaranteed. So, since the cash value is owned by the client, at retirement, the client actually has the chance to withdraw it. Okay, so she can withdraw the cash value by all means. But if the client wants to maximize her cash value, she may avail the collateral loan program. So by doing that, it entitles the client to have a retirement cash flow of at least around 37,900 per year. Okay, that's per year. The longer this client lives, the more 37,000 she may enjoy. And then, since it is a loan program, so the cash flow for this is tax exempt. Okay, and it can provide a client lifetime retirement cash flow. If the client retires at age 85, the total estimated pension that she could have enjoyed is around 680,000. And if she dies at age 85, the projected death benefit by that time will be around 920,000. So this particular plan will actually reward the client as the client lives longer. So in fact, it may provide a long-term benefit of up to 1.6 million because retirement of 680,000 plus a death benefit of 920,000. Isn't that amazing? But let me clarify, none of these numbers are guaranteed, but investments in the markets are never guaranteed anyways. So these are just based on projections. Our projections are based on what had happened in the past. What had happened in the past, the market has been doing quite well. If that will continue to happen in the future, most likely the client will even get more than what I presented here. If I may summarize, Universal Life with retirement, the client doesn't need to die in order to enjoy the plan. Let's face it, if you have a current life insurance right now, it's just for dying. If the client doesn't die, there's no money in it. This plan is also the very effective retirement plan. Nowadays, RSP is becoming more popular as a retirement savings plan because of the tax refund. But a lot of people don't realize that RSP is 100% taxable. The moment you withdraw it later on upon retirement, they will give you T4. Once you add more T4 on your retirement, it can potentially reduce your government pension. In fact, what if the $200 of this client is invested in RSP or TFSA? Most people fail in their financial planning because they have no idea how long will their money last during retirement. And the moment they realize, it's actually late because they are now at the verge of retirement. Okay, just for comparison's sake, what if this client decides to invest her $200 in RSP or TFSA? So in this example, the client is 30 years old. She's contributing $200 per month for an annual contribution of $2,400. So obviously the rate of return is also for 8%, the same projection I use in Universal Life Insurance. So if you notice here, her money keeps growing as time goes by. In fact, after 20 years, she only has $118,600. If she would die at this age, her family will only receive $118,000. While compared to Universal Life, it's $700,000 death benefit. Okay, so which one is better? And then after that, the client stops contributing because the Universal Life is only 20 years. So here we'll mimic the same strategy, 20-year contribution. Let's see which one is better. At age 66, the year before retirement, why I'm using 67 as the retirement years? Because now the government pension starts at 67, no longer at 65. So at age 66, she already has $200,000. If this client will mimic the retirement cash flow of Universal Life Insurance of $37,900, so she will withdraw every year of $37,900. Let's see how long will her money last. By age 73, she has no more money. It would have ran out. By this age, for sure, she's still very active. She only has two choices. Either she's going to go back to work or she's going to be a burden to her family. And that's the sad reality about retirement planning right now. A lot of people don't have any idea that their savings, that their investment might not be enough. Which is why if we compare both strategies, if the client will die young, at least in our particular plan, it has a $700,000 life insurance, which is tax exempt and creditor free. No matter who this client owes money from, they cannot touch the $700,000. That $700,000 will go to the family members. Well, RSP and TFSA, it will never be $700,000. The family members will only receive whatever she has accumulated, minus taxes and minus any loans and creditors. At retirement, at least this particular plan may provide lifetime income. Again, it's not guaranteed, but at least there's a chance. With RSP TFSA, of course not. It had run out at age 72. Imagine that, if average lifespan of Canadians up to 80 to 85 years old. If her money had run out at age 72, what will happen to her? She will become a burden to her family. And then if the client will die of old age, at least in this particular plan, it can potentially give the client around 900,000 of death benefit. Again, the 900,000 is not guaranteed, it's based on projection, but at least there will still be death benefit. Well, with RSP we say, of course, no more. It had run out at age 72 anyways. So again, universal life policy with retirement options for me is really the best plan that you can maximize all the financial benefits on your hard-earned income. Let's face it, we work hard for our money. In this particular plan, at least our money will also work hard for us. Isn't that amazing? Another amazing benefit of universal life with retirement option is that the monthly contributions have certain flexibility. Okay, the contributions are non-obligatory. What do I mean by that? If the client can afford to contribute way more than $200, of course she can later on if she wants to have a higher retirement cash flow. At the same time, in case of financial difficulty, she can also decrease her contribution and she can still be insured with $700,000 with critical illness. And the moment her financial condition becomes better, she can resume her contribution way back to $200 per month. This plan is also perfect for those who are in temporary resident status, like work permit, student visa. Why? Because this particular plan, this client can actually start with a minimum payment of $60 per month, just enough to cover the insurance. Later on, once this client gets her permanent resident status, then she can later on upgrade her insurance plan into a retirement plan as well by adding more contributions to it. So let's create a plan based on your affordability. We can create a plan based on $100, $250, but if the client is able to contribute more later on in life, she can always contribute way more than $200, and that's perfect. And that will even give her a better insurance and a very effective retirement plan. Due to strict guidelines imposed by the investment and insurance industry, I am not allowed to disclose or mention any company or brand within this video. But if you want to learn more about this amazing plan and which company offers this, please don't hesitate to text, call, or email me, and we'll set up a meeting either online or in person, and we'll talk more about this amazing plan. It will be my pleasure to serve you as one of my most valuable clients. Thank you for taking time to watch my video. I hope you learned a lot from it. I also encourage you to watch more of my videos. Please visit my website. It's www.taxcall.ca, and on our website, please click on Tax Tips. And in there are a series of practical videos about personal taxation, investments, insurance, and other financial matters that you might find beneficial. Please find time to watch them and learn from them. It is my takeaway to you guys as one of my most valuable clients. Thank you very much and have a great day.